place I'm actually going to start is within the overview. So you don't get to it on this side menu, it's within the overview. So if I just scroll down, it's actually just beneath the price chart, and it's this section here, shareholder returns. If I click full shareholder returns, I can now see over the last 5 years how the company has done compared to the industry that it's in and compared to the market. And for a company like this, for AT&T, you can see that well and truly this stock has not moved anywhere in 5 years. It's actually only up, based on price, 1.5%, effectively flat. You could have just had your money sitting in a bank account without any interest. Well, at the same time, the market's up 80%. But here's where it gets interesting. If I toggle here, include dividend returns, you can actually see that when I account for dividends on AT&T, actually those dividend payments have been so substantial that you actually be up 80% just with the dividend payments alone. And if you look at the market, a lot of companies in the S&P aren't paying a dividend, so the difference between the total return and the dividend and the return without the dividend is sort of plus 15%. It's not as different. But this is where it's so obvious that for a company like this, investors have well and truly swapped their capital gain for dividend. And they've really lost out on that 80%. So they're up, sure, but they've really just swapped out capital gain for dividend. And as long as they, maybe that isn't what they intended. Now, the next section we're going to look at is, of course, the dividend section, which we can get to here. And by the way, of course, I'm on my laptop, but you can do this on a mobile phone. It's exactly the same on mobile and on desktop for Simply Wall Street. So now we're in the dividend section. This section does also include buybacks. We'll look at that in a bit. But just some of the key metrics that we're gonna pull out here. So we've got the dividend yield, but the one that's really interesting is also the future dividend yield. How are we getting to this future dividend yield? If I go down to this chart here, everything up to this point here is all historical, right? This is all historical data, but then going forward, you can see analyst forecasts. The analysts that cover the company also forecast what they think the company is going to pay in dividends, and so we can actually forecast that out, typically, around 3 years, and we can say, well, what do they think the payments are going to be? And I'll show you in the portfolio later. That's a much better way of saying what the yield is, because the historical yield is not always representative of the future yield. And just pulling apart this chart a bit more, the line in purple is the annual amount. And so how does that relate to the dividend payment? So if I switch actually off the annual amount for now, you'll see this is just the pure payments. This is just the reported payments. And of course, the payments were cut pretty much in half in 2022. You can see that there. But before that, they were actually increasing. You can see here the payments are slowly increasing, and then they got cut. The annual amount, though, is an easy way to think about it, because these payments can be sometimes a bit all over the place, and it's hard to add that up in your head. Well, how much is that per year? Whereas this line shows you the annualized amount of those payments, and of course, as we said, it was cut there. And so what's really powerful is then to compare the annual payment amount with the annual earnings per share. So I've just toggled the earnings per share on. Now, earnings per share, of course, can be a lot more volatile, but you can actually see how those dividend payments follow the earnings per share. And for some companies, they'll be pretty much lined up because they're heavily related. So that's actually off by default, but you can toggle it on. And the last one here is, of course, the dividend yield. Now, the yield is really up and down because the yield is actually the dividend. Well, it's the annual payments compared to the share price or the market cap of the company at the time. So of course, it can be really volatile, and you might get into the company at a certain point, and then you're going to have a higher yield. And so that's why this historical yield is really can be quite volatile. And going forward, you could sort of think of that as yield on cost, because we're going to say, well, going forward, we're going to forecast that yield, assuming you bought it today, right? That's why it kind of suddenly goes flat going forward. Now, the next part I just want to touch on is this one here. This is just a good way to frame up how much the company is paying versus what else is in the market, because sometimes it's hard to know, is this a good yield? Is this normal? And it varies wildly with different markets. For example, in Australia, the companies pay generally higher yields than the companies in the US because they're doing more buybacks often. But again, the way to frame this up would be, this is what the company's paying, This is the bottom 25% of the market, so the sort of lower quartile. This is the top quartile, so this is really like the sort of top 25%. This is the average in the industry. Again, for a company like AT&T, they will be dominating this industry, so that there'll be a major factor there. And finally, that, like I said, that forecast yield, which in this case is exactly the same as the current yield. And the last part of this, of looking at dividends, is what's called payout ratio. Payout ratio is what percentage of the company's earnings, and we also do cash flow here, do the other dividend payments. And this is just a very common way to look at affordability. Can the company afford to keep doing these payments? You can see here that on an earnings basis for AT&T, you've got 63% of their earnings being paid out as a dividend, which is actually reasonably high. And then on a cash basis, you can actually see there's only 40%, so it's quite a lot lower. Now, related to this, if you're interested, I'll do a separate video entirely on this topic, hopefully. But related to this, you can actually go to the past section, and you can go down and you can actually see how do cash flows and earnings compare. In fact, for AT&T, you can see that actually the earnings and the cash flows are somewhat similar, but there's a lot going on in between that. But that's a subject for a completely separate video. Now back to the dividend section. So I've gone back to the top again. For all of the parts in this report, Simply Wall Street has 6 checks, and those checks are meant to be independent, and they're meant to all add up to looking at all these different factors. So 6 out of 6 would be this company is passing all of the dividend checks, and 0 out of 6 would be it's not passing any of them. So AT&T, you can see 3 out of 6, and I'll just quickly run through those checks because we're going to use this later when we're screening in the Snowflake. So if I go down, the first 2 things we're checking are, is it a stable dividend, right? Has it dropped at all, which it fails because we can see the dividend dropped here, and has it been growing, which of course it also fails because it hasn't been, it hasn't been growing, it's dropped. So you really want both of those, right? Now you can still actually pass the growing one with a drop as long as the current payment is higher than what it used to be, and there's a trend of going up. That's okay. So you can still have one and not the other. But the stability as well, we can sort of handle small changes, but I think there's a threshold of more 20%. So you can't drop more than 20%. If it drops more than 20%, then it wouldn't be considered stable. The next ones are around the yield. So we're just trying to look at how competitive that yield is. The first one is actually, again, what we call notable. Like, is it a meaningful yield? I would argue that if it's not kind of notable, then you're below kind of that type 2 that I mentioned earlier. You're starting to get into type 3 type companies because it's such a small yield. It's not going to be that significant. You're almost better just thinking of this company as this is just a normal growth stock because the dividend's so small. And then of course there's the high yield, which if you are looking for that aristocrat kind of dividend powerhouse, you really would be looking for something that's paying above that, or if not, you go look elsewhere because the idea is that there's companies out there that are clearly paying that. Down here, we're just checking those payout ratios, both compared to earnings and cash flows. So again, we're just looking for that dividend to be well covered based on those results. And that all adds up to those 6 checks. And I'll just finally add that in this section, of course, we do include buyback. So buyback yield is also here, which is sort of like the equivalent percentage that the company's buying back shares. The buyback yield in some companies, which we'll see earlier, can be negative. What that means is the company is overall issuing shares. That's quite common. And then when we add those 2 together, you're going to get the total shareholder yield. So if we add those 2 together, we could think of that as an overall shareholder yield, but which is something I'll cover later, is buybacks are not quite the same as dividends. You're not going to get that payment in your pocket, but I think it's just really powerful, and we can screen for that as well. Let's now look at those same metrics, but let's look at a few different companies. This is AT&T, and so we saw for AT&T how the company basically sort of eroded shareholder value, which we can see here. It's really eroded shareholder value, and if you didn't have those dividends, it would be really quite underperforming investment. Ideally, with dividends, you want a bit of both. You ideally want to match the market, and you want the payments. So you can see here that this company has clearly underperformed the market, and right now, from a dividend perspective, it's looking a little mediocre. It's not really passing all those checks. It's got a 3.8% yield. It's not too bad. And one final thing though, where I think you can frame that up is, as I mentioned, you can look at the valuation. So what we can actually see here is not only is the company looking undervalued based on cash flows, right? That means that, you know, investors really don't have a lot of hope in that company. They're really, the cash flow value is way, way higher than the share price. But more importantly, the P ratio of this company is 16, right? And that's what I'm going to look at later. That's not a super high P. It's actually kind of low. The best way to put that into perspective would be to go here, and we can actually see, well, okay, P ratio of 16. Well, there's some companies that are much higher, but we've actually got something like Verizon with an even lower P. So it's sort of a mediocre P ratio here, and you can sort of see where it sits if we zoom out. But that's important because what it means is that this is how the market is valuing their earnings. And if the earnings are valued highly, as I said, it becomes difficult for that yield to become really high because they're already valuing the earnings very, very highly. Let's now contrast that to a company like Verizon, which is here. So this is Verizon. I've just swapped to the next report. The first thing you can really quickly see from this report is dividend 6 out of 6. That's coming out straight away, but also the company's clearly, it's almost passing all of the value checks. So undervalued company, and therefore, of course, the dividend is getting 6 out of 6 as well, but almost 0 on growth. Very interesting, and it kind of in the middle with past and health. So not looking too hot there. So I'm going to check those same things quickly. The first place I'm going to go just below the share price chart. I'm just going to look at the shareholder returns. How has this company performed in the last few years? And oof. So you can see here, Verizon. If you thought AT&T was bad, this is a lot worse, right? So you're actually down. Shareholders are down 25% in the last 5 years. That's not great. Again, same market. So the market's the same. Let's include dividend returns and let's see how that compares. Okay. Sorry, I shouldn't be laughing. When you account for dividends, you're almost above water, not quite, right? So when you account for dividends, you roughly kept on hold of your money, which is better than nothing. But really, you know, from a capital value, you're really quite down. So that's really not great. This is even worse than AT&T. You've really eroded some value here if you were coming into this company for the dividend. And just whilst I'm here, I'll just go down a little for the value section, because again, this company's looking really quite undervalued. That really tells you a lot. If the company's undervalued, why is the company undervalued? Why is the market not valuing these earnings? And even lower P ratio of 10, and we looked at that earlier. So that's something to keep in mind, right? We're really sort of looking into that value trap zone, and so this would be a type 3 company that we talked about. Coming back to the dividend section here, it's getting 6 out of 6. And this is what I tried to say a little earlier, that for these type of companies, they pass, from a dividend perspective, they can't be faulted, right? Let's look at that. So it's a great yield at 6.1%. Doesn't seem to be doing any buybacks, but it's a really good yield. Dividend's growing, 2.1. It's growing slowly every year. It's not a particularly high growth rate for the dividend, but it is growing. That's why the forecast yield is a little higher. That's what they're expecting. You can see here, I'm just going to remove the yield to get that picture, but it's just like, again, it's like clockwork. It's super consistent. That dividend's going up every year. The payments, there's a completely reliable payments, and it's probably going. From here, we can take a look at how that yield, 6.1% compares. And as you can see, it's really up there. It's way above even the industry average. And so, again, this is really a type 3 company. So it's getting both those checks here. And then finally, these payout ratios are pretty reasonable, right? It can definitely afford this dividend payment. You've got roughly 60% of earnings and 60% of cash flows being paid out. So let's now change over to another company, which would be Eni. So Eni, if you don't know, is the Italian sort of I don't want to say state, but anyway, Italian oil and gas company. And so this is an interesting one. So let's go through those same checks again. I'm going to start off with the share price return. So like I said, just underneath the price chart. And let's start here. So we can see that over 5 years, Eni has actually returned, this is without dividends, actually returned almost 100%, right, 95%, which is pretty good. That's without dividends. And now we're contrasting. Remember, we're in a different market now. We're looking presumably in Italy, And so that market just hasn't done particularly well in the last 5 years. So it's been fairly easy to outperform. In fact, you wouldn't be too happy, I think, with 11% over 5 years. But let's include dividends and see how it looks. So when we include dividends, what you can actually see is makes a huge difference. You're going, yeah, 95 over 5 years. Okay, that sort of not amazing. It's okay. Better than US market, but the dividends make a huge difference here. I mean, those dividend payments, getting up to 170% over 5 years. And interestingly, my hunch is that E&I is probably a large portion of that market, because the same seems to be true for the Italian market. So again, this again, I think people would be fairly happy with that. And it's not, they haven't lost out on that capital appreciation there. So go to dividends. Again, we've got that really high yield here, fairly negligible buyback. And let's have a quick look. Why is it getting 3 out of 6? So we can find out. This is always useful. You've got if the dividend payment has been announced, then you have to buy it before the ex-dividend date. So if that's interesting. Now I think this is the best. This chart tells us a lot for this company, because I'm just going to first of all switch off everything apart from the payments, and you can see here it's pretty obvious, but reasonably stable payments, not particularly growing. In fact, if we go back up here, it's almost a negligible growth rate. So this is not a growing dividend, that's something to keep in mind. But it really, you can see it's been cut here, right? So it's really not growing even afterwards. They kind of keep it the same, and so that's why just from these payments, it's definitely not getting the check for the stable dividend, and it's not growing either. It's easier to look at the annualized amount, I think. Again, that's also pretty volatile, although increasing since 2021. And like I said, comparing that with the earnings per share. And by the way, this white line here, that's the zero crossing line. So you can see the earnings per share, but it's basically going from positive to negative to positive. And that obviously is probably one of the reasons why they've paused those payments. Now let's just quickly check the yield. Again, that yield's really up. That's definitely pretty hard to top that one. But what's interesting here is that it's not actually covered by earnings. It looks to me that there's quite a lot of volatility here. It is covered by cash flows. The next place I would go would be I'd go and look at the earnings versus the cash flows and try and see what's going on there. It's an oil and gas company. They have lots of assets. They have to depreciate, things like that. But this would certainly be worth diving into. Again, on the surface, the two look similar, right? You've got 2.3 billion versus 4 billion, but actually there's a lot going on there. Right. Let's go and do some screening.